You're recording. Okay, anyway, synonym for left is debit. Thank you very much. Okay, synonym for left is debit, and I don't know why we do DR because it's spelled debit. It's really from the Latin root. But I won't tell you, but these things are backwards in terms of the Latin roots. But, yeah, let's not go there, right? And the debit really is right. Yeah, and there not. Okay, debit means what? Left. Only left. Doesn't mean plus. No. Sometimes, but not always. It's worse than no. Sometimes it'd be right, sometimes you'd be wrong. And obviously, then, if you have that memorized, and you know the debits have to equal the credits, right? Credit must mean what? Right. You got it. At least there is an R in credit, huh? That's nice. Okay? So debits equal credits. That's it. We'll always use DRCR. Okay? You should have this written down. Take a note card or something. I don't know where you put it. Have this written down. Have it sitting in front of you when you work problems until you don't need it anymore. Okay? When you come in and do the first quiz, and maybe even the second quiz, and maybe even the first test, take a blank sheet of paper while you're waiting for me to hand out the test, and write this down on it. Okay? This and the accounting model that we're going to do today. You use it forever. Okay? All the way through. You use it forever. All the way through all the coursework. And there's only going to be debits and credits. There's nothing else going to be added. Okay? And 5 types of accounts. An account is a place where we keep track of all our stuff. Okay? We keep track of everything. But there's only 5. Okay? Only 5. So if we can do debits and credits with just 5 accounts, we can do anything. I mean, I'm going to be teaching auditing this afternoon, accounting 418, right? Guess what? It's a bunch of debits, credits, balance sheet and income statement. Balance sheet and income statement is just what? What goes on a balance sheet? You guys read these chapters. What goes on a balance sheet? On the left is what?
Assets.
Assets. We'll use A for an abbreviation for that. Isn't that clever? Okay? Accountants are so clever. We call things what they are. Okay? A for assets. Okay? Big deal. Right? And of course on a balance sheet you write the word out, assets. Okay? But this is called the accounting equation. Big deal. Okay? It's just a balance sheet. Okay? Assets equal what?
Liabilities plus stockholders.
Liabilities plus stockholders' equity or capital sometimes if you're in principal class. How many of you had principles of accounting, by the way? Anybody in here had principles of accounting in high school? Okay, yeah, that's a disadvantage. Probably. Did you go to St. X? Have a good meeting? No, okay. Then it's an advantage because you really push it. Have them learn. Otherwise, it's probably a disadvantage. Really? You know why? Because you memorized a whole bunch of crap. So don't think that it's bad if you never had accounting before. It doesn't make any difference whatsoever. Okay? Probably doesn't help you if you did. Okay? That's sad, isn't it? Courses are way too easy. Expect you to learn way too little. I'm really good at accounting. I've had kids come in and say, yeah, I was really good at accounting. I got B's in high school. I took 2 years. And then I thought, oh, yeah, wow. So I feel real bad. I hate that. Flunk students. Don't let me do that for any of you guys, okay? Don't. Oh, better way. Don't make me do that. Right? If I have to give you an F, you will have earned it. Although, why am I saying that? People are getting an F aren't here today. Already. Yeah, I'm not kidding. Yeah, it's sad. Okay, anyway, assets equal liabilities. Plus what? 2 S's at the end of liabilities, huh? Plus equity, stockholders' equity. All right, somebody tell me what assets are. They're my what?
Resources.
I think all these things are resources. Oh, different types of resources. Yeah, they are resources. But yeah, what's that?
So you could turn into cash.
Things I could turn into cash. I get cash from a liability. If I borrow money, I get cash from equity. No, I'm good. What are assets? Pretty simple. Come on, somebody jump in. By the way, it's not any fun for me if you don't try. I mean, if you don't throw out an answer so I can make fun of it. Come on, give me an answer so I can make fun of it. What's an asset? Somebody do it.
Economic benefit of past transactions.
Oh, yeah. Their future economic benefits obtained or controlled by an entity as a result of past transactions. That's the definition. You're going to get 211. Pick a kind of 211. That's what they are. Probable future economic benefit obtained or controlled by an entity as a result of past transactions. Make it present.
You know what?
Can you still do that? You can. Okay. Give us the definition of liability. Yeah, she can take this Yeah, that's true, but what does that mean? It's all my stuff. It's all my stuff. It's all my possessions. Here is an asset. It's not my asset. It's her asset. Here is there's some left. Yeah. Here's an asset. Not much of one left. It's all gone. Okay. Here's an asset. It's hers, not mine. Here's another asset. This one's mine. Any possession. This screen's an asset. This, whatever that thing is an asset. This book is an asset. This cover on the light switch is an asset. The door is an asset. All those chairs are different assets. All the tables in the room are different assets. Everything in the world that you could possess is a asset. How many are there in the world? Billions. But you know what? If you know their assets and you know how to account for assets, you can account for them. Wow. So do you want to memorize how to account for all the different billions of assets? Or would you just rather think about, is this one of my possessions? Something, my stuff, right? Is this one of my possessions? Whether I own it or not, one of my possessions, what I have control over. That was the idea of control in that definition, right? Okay, that definition is right, exactly right. Okay, my stuff, what I have possession of, are my assets. And there's billions of them, so you don't memorize how to increase and decrease accounts receivable. You know that accounts receivable is a what? People owe me money. One of my possessions. It's an asset. Inventory. Go to Kroger. All the stuff in the store. All those things in the store that you might buy. Right? Those are assets. They belong to them now. When they sell them to you, they become your asset. Right? Cease to be theirs. So we're moving the assets around. So all my possessions are my assets. So this crap up here are my assets. The stuff sitting in front of you is your asset. Got the idea? Okay. All right. So assets are anything that we might possess. And to give you an example of this, my wife and I have a little house that we bought for $170,000. It's probably worth about $200,000 now. Okay, houses are not good investments. They increase in value extremely slowly. Sometimes even decrease in value. But anyway, my wife and I put almost nothing down on the house. Maybe nothing, right? It was close to that. And right now we still owe about $170,000. I'm 65 years old and I don't own my house. It's a terrible thing, isn't it? I only have $30,000 equity and it's a little tiny house on top of it. Right? Over here, mile and a half from here. In the poor part of the Highlands up there. Little tiny bungalow. Huh. And this was really a horrible thing, right? No, it's not. You know why I didn't put any money down on the house? Because they loaned me money at 3%. You know what I make on the money I have in the stock market? On an annualized basis, year after year after year for the last 30 years? Close to 40 years now I've been investing. 12%. How much money are you willing to borrow at 3% if you can earn 12? All the money in the world. If they loan it to you. But you know what? The more you borrow, what happens to your interest rate? It goes up, right? So here's the deal. In companies, it's good to borrow money. For individuals, it's good to borrow money. If what? You can pay it back. What does that mean? The rate you borrow at is less than the rate you earn. Problem is when you borrow money, the rate you have to pay is fixed. How about the rate you earn? Oh, that depends on how much you earn. What could happen? You could not earn, and now you're bankrupt. Right? That's the risk. So it's risk to the bank, it's risk to the investors, right? Got it? Okay, anyway, so here's the deal. We have a $200,000 asset. Let's say it's worth that. I don't know what it's worth unless I sell it, right? $200,000 asset. We owe $170 against it. Who owns most of that asset? The bank. How much do we own? 30. Got it? Okay? So you don't have to own your assets, you possess them. You're using them, right? Are there some assets I own? Well, yeah, I think that coffee cup thing or teacup or whatever it is, we own. It's coffee cup. We own that thing, my wife and I. Huh? That's our possession. It's worth anything, but we own it. It's our asset. Got the idea? Okay. Our house we don't own. She wants to buy a new car. It's going to be about 40 grand. I'm working on getting it lower, but I can't. She's really cute, so you know what I'm going to do. Right? She can have anything she wants. Okay. She can have anything she wants. I just pretend she can't. My granddaughters, they literally can't have anything they want. Yeah. Luckily, they're only 5, so they don't want much yet. I can afford it still. Anyway, she's going to buy a $40,000 car, probably, maybe more. God, stupid. Okay, anyway, she's not stupid. Paying that much for a car is. Okay, anyway, you can't make any money with it. You just drive it around and it goes away. And then you throw it away. We got one that she bought 10 years ago for $30,000, which is about as nice a car she's going to pay $40,000 for now. No inflation though, right? In the last 10 years? Yeah, right. Anyway, so we're going to throw that one away because it's pretty much worthless now. 150,000 miles on it, trade it in for, get nothing for it. Anyway, we're going to get rid of that one. We're going to get another one, right? 4 wheels on, an engine. Difference doesn't make. But anyway, so we're going to do this. How much wealthier will we be when we borrow $40,000 to buy a $40,000 asset? Not at all. How about when we drive it off the lot and now it's worth $30,000? Because it's going to be new. Oh, wait a minute. Now it'll be 10,000 negative wealth, huh? From that, I'll lose 10,000 when we drive it off the lot, right? It's okay. I think it'll be fine. Again, she's cute, right? Stay away from women. Well, actually, nowadays, stay away from men. It used to be, they had this thing they called the MRS degree, right? Mrs. degree. Now I guess it's a MR degree. Guys come to college to meet really bright young women that are going to support it for the rest of their lives. That's what you guys are hoping for, right? These two look pretty smart and they're really cute. You could go on with them. Hope they don't find out that you're lazy and don't do anything. Never going to make any money. Women are smarter than men about that, though. They get rid of men that don't make money. Women just sort of hang in there. My wife did. She's with me. So. All right, anyway. Got the idea here, you guys? What's liabilities then? What's liabilities? Anything you still owe. That's it. Anything you owe. Okay, how many people in the world? So many other slides said over 7 billion. How many people do we owe money to? Sometimes I feel that way. Not really. But yeah, 7 billion, huh? All the companies in the world. And there are different ways that you can owe money too, right? You could have notes payable, contracts payable, you have an auto loan payable, mortgage in your house. Right, guys? Accounts payable. Let's open an account. Salaries payable, rent payable. So you got a whole bunch of people, like 7 billion, a whole bunch of different ways. Got the idea? How many liabilities are there in the world then? Billions. But guess what? If you know how to account for any of them, you know how to account for all of them. If you know how to account for liabilities. That's it. So if you can determine something's a liability, anything I owe is a liability, huh? Got it? And in equity, what's that? It's a representation of your wealth. And luckily, there's only going to be a few accounts, a few places where we keep track of our equity, okay? Where we keep track of our wealth. Only a few. And you'll have to learn all those because that's new to you probably, okay? But it's just a representation of your wealth is the equity. Got it? Okay, so this is pretty straightforward, don't you think, so far? Okay. Oops. Let's get rid of this. Right? So all of this stuff is called a what? Balance sheet. And here's the deal. We call it a balance sheet because the left side equals the right side. We put the assets on the left. And again, what do you memorize? Assets go on the left, which forces what? The liabilities and equity to be on the right. Okay. Does that make sense? And left means debit. And right means credit. So the normal balance in assets is going to be a debit. Why? Because assets on the left and left means debit. That's it. No, nothing more complicated than that. Common sense then, huh? The liabilities and the equity are on the right. So for both of those, what's the normal balance going to be? Credit. Why? Because they're on the right. That's it. Okay? That's it. No more complex than that. Okay, guys? By the way, is it common sense that all your stuff, either you're still paying for it or you own it? Any of you guys have any stuff that you don't either own or you're still paying for? No. That's impossible, right? So this is just logic. Huh? Very simple. Very simple. You guys are just kind of scary. Right? You're all right? Okay. It's okay. You guys can have whatever demeanor you want in here as long as you're learning this shit. I could care less. Right? Okay. If you were working for me, then you'd have to, communicate a little more that, you were really into it. Right? It's just that the other group were kind of leaning forward the last hour. Maybe I scared the hell out of them, and you guys are all the strong students, so you're kind of, what the hell? Right? It's okay if you deliver on the tests and quizzes, right? Yeah. Otherwise, open your eyes a little more, lean forward, go for it, right? You sort of tell how engaged people are or aren't. When do we have the quiz again? Right. Am I expecting you to know how to do this inside now? Yeah. Am I just going to ask you what these things mean, or am I going to expect you to use them? Oh, use them. Have you taken a look at the quiz yet?
Yes.
We're going to do it next time. We'll work on it a little bit next time, huh? Do we have a review day, too? It's Wednesday, isn't it? Oh, for God's sakes. Okay, anyway. You guys are going to bring extra money to pay me for doing this. That's fine. Okay, anyway. I'm just such a bad teacher. I have to have a lot of extra hours with my students, so nothing I can do about it. You'd think after 35 years I'd be better, so I could just get it done in 15 minutes. I can't make it, sorry. So you guys suffer, and I do too. You got to get together more. By the way, you don't have to use the reviews if you don't want to. State. Income statement, okay? What goes on an income statement? Balance sheet is a picture of where we're at right now. Income statement is what? How much income we earn, right? Okay. So revenues. Now these are probably new to you. What's the other one that's going to be in? So we got 5 accounts: assets, liabilities, equities, revenues, and expenses. Everybody see it? If you know how to handle those, you got it made. Okay. And the difference between your revenues and expenses is going to be called net income. But that's not an account. That's just the difference between the two. Got it? All right. Or you might have a net loss. And what a net loss would be is, well, you lost money. Kind of makes sense. Net income is you made money, right? And when I say money, I don't mean cash. I mean, well, measured money. We'll get to that. Okay? All right. So assets are all of our possessions. Liabilities, all our stuff. Liabilities is everything we owe against them. Equity is the portion we own, which is a representation of our wealth, right? Okay. Revenues, what's that? Earnings from selling goods and services, right? Sales are revenues, okay? And maybe rental income, interest income, other types of income, other types of revenue, okay? So revenues are the increase in our wealth, increase in our equity due to earning, okay? Revenues are a representation of the increase in our wealth due to earning. Got it? Okay, that's what's going on. So I have more wealth because I'm earning, okay? What are expenses? All the what? Costs I incurred to get the revenues. All the costs I incurred to get the revenues. Okay? When you bought your book, right? Their sale is the sales price, right? Okay, which is going to be what you pay for it, right? But they have the sale because they gave you the book. You gave them your promise to pay, or you paid them, right? Okay? So the sales price would be sales. But what's their major cost? They had to buy the book to sell you the book, right? So they have a major cost, which is going to be called cost of goods sold, by the way, right? It'll be cost of goods sold is the cost of the book, which is their major cost, which is a what? All the costs are called expenses. They'll also have employees. The bookstore, they have employees, right? Okay? Even if you order it online, right? The warehouse has employees, Amazon has employees. What's the deal? That's salary expense for them. Okay? And then the building, rent expense, or later depreciation expense if we own the building. Okay? What are expenses? All the costs I incurred to get the revenues. By the way, nobody incurs any costs that are not going to generate revenues, or at least they don't think they're going to generate revenues. Right? You don't hire people just because, oh, I like them and I think they're people are nice if they made a living and you can come in here and we don't generate any revenues with them, right? No. You guys have jobs? Your employer pays you based on how much revenue you are generating. They do. How do you get so you make more money than the measly salaries you guys get, wages you guys get? Get more valuable. What do we mean? Get so you can produce more revenues. My rule of thumb was 3 times. If they're going to pay me $50,000 a year, I'd want to generate 150 buildings to a client. So the partners make a lot of money off of it. And then what will they do? Beg me to stay. One of the ways they beg me to stay is what? They don't really beg you. They just give you raises and promotions. I never asked for one in my life. It just kept coming and coming and coming. Until I started teaching it now. Well, that's right, I don't do anything. Good point. Okay, so you don't have to work, you shouldn't have to get paid very much. Okay, anyway. Let's put debits and credits in this, you guys. Let's do it. This is common sense. Tell me which side the assets are on. Left. Tell me which side the liabilities and equity are on. Right. How are you going to increase assets to get a normal balance that you'd like to have on assets? What do you think the normal balance should be, seeing as they're on the left? Debit. How are you going to make them a debit? Increase them with debits. So every time I receive an asset, I buy an asset, somebody gives me an asset, whatever, I get one anyway. Every time I increase assets, what am I going to do to it? No matter what the asset is, of all the billions there are in the world, if I have more, what do? Debit it. Which means what? It's on the left. I'm going to record it on the left. Record means write it down. I'm going to put it on the left. I'm not kidding. That's how simple this little system is. I'm going to increase them with debits. How are you going to reduce them? You guys read about this, right? You guys have read chapter 3, haven't you? They don't really quite fill it all in until you get there, huh? 2, they talk about it. 3, they actually show it, right? Work a bunch of problems, you guys, okay? And try working that quiz that I gave you, okay? And we'll do it in class next time, okay? Did you guys give me the time you were going to give me? Don't get behind. You have to do the hours anyway. When would be the better time to study for this quiz, before it or after? Duh. Have you been studying for it? Some people, yes. Some people, don't know. Haven't read a page yet. Oh, well, there's next semester. It's no big deal. Okay, anyway. So, not even kidding. By the way, if you don't get these first couple chapters, it's over. If you don't understand this stuff, it's over. It's the model. We're going to use it all the way through. So, you know what? You could not write a novel if you can't spell. You can't even spell if you don't know the alphabet, do you? And don't they start with the alphabet? Okay, anyway. All right. How would you reduce it if you increase it with the debit? It's got to be a credit. That's all there is to it, you guys. Both of these, liabilities, they're on the right. How do you increase them? Credit. Credit. You get a normal balance of credit. How do you reduce them? Debit. Okay? Because it's got to be the opposite. We're always taking the difference between debits and credits. We don't have to remember what to add and subtract. Nice, huh? Okay, equity, it's also on the right. How do you increase it? Credit, because it's on the right. How do you reduce it? Okay. Now the reality is, revenues and expenses are subsets of equity. What happens as I sell? As I sell product, goods or services, right? Goods being a book, services being accounting fees, if you're working as a CPA, right? Law fees, if you're a lawyer. Okay? As I earn revenues, what happens to my wealth? Come on, you guys. What happens to your wealth if you earn revenues? It goes up. So revenues are a subset of equity. What we do is we keep track of the revenues for 1 year, and then we add them to equity. We keep track of all the expenses for 1 year, and then we take those out of equity. So the net income that ends up being added to equity, or the net loss, if it's a loss, reduces equity. That's how it's going to work. Okay? That's in chapter 4. Okay? So we're getting there fast. Okay? All right. So revenues are what? An enhancement of equity. It's going up. So they must be what, everybody? They got to be credits. So when I increase revenue with a credit, I am increasing equity effectively. Got it? Oh, by the way, the authors put down A, L, E, whatever next to each one of the accounts as you're doing debits and credits. Don't do that. Nobody does that. I know an account is what it is, or I couldn't make the journal entry. I know cash is an asset, right? I know land's an asset. I know notes payable is a liability. I don't have to write down next to it what it is. Don't do that. Okay? Nobody does that. Okay? We know what they are. Also, don't write debit or credit down. You don't need to do that. Put the debits on the left side, both the name of the account and the dollar amount, to the left. Okay? Credits, put them to the right. And we know they're debits and credits. It's a really nice little system. You don't have to write that down. That's silly. Okay? By the way, the author isn't really doing journal entries at the beginning. They're doing this plus and minus nonsense, aren't they? Do not do that. Do debits and credits. I can't find a textbook that actually does that. And this is the best textbook that I can find. Okay, I know it's ridiculously expensive. Okay, but that's because it's so widely used, because it's really good. Okay? I'd rather have you spend the money on the book than waste your time reading something. Yeah? Okay? Okay. But even that, I wish they would put those 3 chapters into 1 chapter and get rid of all that plus and minus nonsense. So don't you guys do that. It's not plus and minus, it's what? Debit and credit, which means left and right. I don't know why we don't call it left and right. It's so much easier, huh? Okay. All right. Revenues are increased with credits. What if you put too much in when you want to fix it? You don't draw a line through it and change it. It's in a computer. Come on. What do? Reduce it with a debit, just like that. Yeah. Okay. So if you put too much in revenue, you take it out with a debit. Okay? How do you increase expenses? They must be the opposite, right? So they got to be debits for that reason. Increase them with debits. Reduce them, therefore, with what? Credits. Absolutely, guys. That's it. Okay? But what else? What's the other reason? The real reason. Expenses, as they're being increased with debits, what's happening to your wealth? As you have more costs, your net income's going down, right? Or your net loss is going up. As you have more costs, you have less income, don't you? Less equity, less wealth. How do you reflect less wealth? With a debit. So as I am increasing the expenses, I am reducing my wealth. Make sense? Kind of turns your brain inside out. But that's all it is. Everybody good? That's the whole model. That's everything. Now we can do everything. I'm not kidding. This is it. So anytime you don't know what you're doing, I can't remember what to do. Stop it. Do you remember that debit means left? Do you remember that assets are on the left? Then everything else you can figure out. So stop trying to remember. If you're sitting there saying, I can't remember what to do. What do you mean you can't remember? I'll make fun of you. In class I will. In my office I will, right? What do you mean you can't remember it? I don't even know who you are. I can't remember your name. It doesn't have anything to do with whether you know this. What does have to do with whether you know this? Whether you know this model, you understand it, you can use it. That's it. All the way through. I'm going to do accounting 418 this afternoon. Auditing. Right? We're going to do debits and credits. They're auditing all this stuff. Balance sheet income statement. By the way, balance sheet income statement is not the accounting equation, right? They're financial statements. Think about this. At how many transactions do you think Amazon has a year? Billions. I bet it's billions. Okay? They add them all up, and they put them all on one sheet of paper called the balance sheet and another sheet of paper called the income statement. Billions. This little system does it for them. And guess what? There's not a human being sitting there doing billions of them. The computer does it for you. Right? There used to be, accounting has a horrible reputation because there used to be bookkeepers, and it still sticks and sticks and sticks. Bookkeepers made basically minimum wage, and they sat there for their entire lifetime writing things that looked like the right thing. Of course, it was horrible. That's not accounting. Accounting is the computer adds up billions of transactions, or millions, or thousands, depending how big the company is, and then the accountant looks at it and determines whether or not they're right or wrong by looking at 2 sheets of paper. Oh, wow. But you know what? It was always like that. The bookkeepers would put them all together, and the accountant would look at the 2 sheets of paper, right, and tell whether or not it's right or wrong, and figure out what's wrong, fix it. Got it? Oh, and determine what you should do next to make it better. What kind of decisions should we make running our business? Got it? How come so many accountants and finance types run businesses? Because they know where the money came from and where it went. What do you want running your business? Right? By the way, if you don't know about accounting and finance, you will never be a CEO, chief executive officer. You just won't. But if you don't know about marketing, human resources, and production, and distribution, get the idea? Everything. If you don't know about everything, nobody will ever let you run your company. Anybody going to be an entrepreneur, going to have their own company maybe someday? One guy in the other class, maybe? Yeah. You think it might be important for you to know where the money comes from and where it goes? Oh, but you know what? If you don't know how to sell products to your customers, you can know where it came from and where it went, but most of it will be where it went, right? There won't be any coming in. And if you don't know how to manage your employees, you don't know who to hire, when to fire somebody, if you don't follow the law, it's over, right? All of it's critical. Okay, guys? So when you're taking all these classes, soak it up, soak it up, soak it up, soak it up. How many of you want to make $25,000 to $30,000 when you graduate here? How many would rather make 50 or 55? Work while you're here. We can tell the difference between how hard some people work and how hard other people did. It's right in GPA. It's right there. I don't mean every single class, it's all the whole hell of a lot, right? Okay. I know people who had a D in class while they went through college and got really great jobs, right? Okay. I know people who had 3 5s when they graduated and did a horrible job once they went to work. They're too full of themselves, right? Couldn't get along with other people. So yeah. Anyway, let's change this just a little bit. Let's do another thing here. Let's do dual page on. I'm not such an expert at this. I know you're impressed. Okay, give me another one. How come It gave me dual page, but it doesn't want to give me it. So. I'm impressed with myself because I was so good at this. Now I want to do it. Where are you? Filled them all off. Filled out my debits and credits.
Here, go back, click to the right. The arrow right next to the one you just clicked.
That one?
Yeah, click it.
Read.
Click it again.
No. Not going. Let's try this. No, they're supposed to be lined up right here. Aha! Nope, didn't do it. Destroyed it. Okay, I hit something wrong. Right when I was trying to impress you guys with how good I was too. Okay, anyway. Here we go. Have this down on a note card, right, everybody? Debit equals credit. Left equals right. Until you feel it's ridiculous to be using the note card, throw it away then. Okay? You need to know this as well as you know your name, right? All you have to know is left. Debit means left and assets on the left. The rest of it, common sense. Okay, here we go. These were increased with what? Come on, you guys. Increased with what? Debits because they are on the left. Reduced with? Credits. Both of these are on the right-hand side, therefore they're both increased with? Reduced with? These are a subset of equity, right? Revenues and expenses are. So revenues are increased with credit because that's increasing equity, right? Okay. Expenses have to be the opposite, and they're reducing equity, so they are debits. Excellent. Okay. Net income, a debit or a credit, by the way. It's not an account. It's just the difference between the revenue and expenses. If these revenues exceed the expenses, your sales exceed your costs, what do you have? Positive net income, which is a net credit. So credit is good here, right? In that case. How about a net loss? What would that be? Debit or credit? If you had a net loss instead. That'd mean your expenses exceeded your revenues to be a net debit. Got the idea? And in that case, debit would be bad. Let's do good and bad, plus and minus on this, okay? Just to really break through this, because this is what gets people. If you think debit means good or credit means good, either one and the other one, the reverse, you're dead meat. You'll be right 60 or 40% of the time. So you're right enough so that you think it works, but you're wrong enough so that it collapses on you. And you end up trying to debit two things or credit two things, and your journal entries don't balance, and you start pulling your hair out, okay? Same with plus and minus. It does not work. Let me show you. Let's do good and bad. How many of you think that increasing assets is a good thing? Everybody, right? So asset, for asset, debit means good, right, you guys? Everybody agree with that? I agree. It is. Okay, for liabilities. Debit reduces your liabilities. Good, huh? This is working great. I'm really happy. It's fantastic. How about for my wealth? Debit means reducing my wealth, doesn't it? Good or bad? Bad. All of a sudden, whoops, bad. All of a sudden, I've got good, bad, and I'm going nuts. What's going to happen, of course, on revenues? Increasing expenses, debits would be what? Remember, debits reduce these. Credits reduce these. So is debit good or bad on revenues? Reduce bad. Matching this one, of course, because it's a subset of equity, right? How about expenses? Debit, increasing whatever's your wealth. Goes down, bad. See if you right 60% of the time, or 40% of the time, right? You'd have a good one here and a good one here, and everything else is bad. Drive you crazy. Okay, what about credit? It's just the reverse, right? Credits here are bad. Credits here are bad. More liabilities. Credits here are good. I'm going crazy now. Right? Credits here are good. And credits here are good. Again, 40-60, huh? Don't go there. Let's do plus and minus. Is debit plus here? And credit minus? Yes. debit, no, wait a minute, debit's minus on both of these. And credit is, right, and credit is plus on both of these. I'm going crazy, right? Debit here is minus, credit is plus, right? So backwards from assets, get the idea? Doesn't work, does it? Don't go there. On expenses, by the way, that one does work. Debit is plus and credit is minus. So again, you're right 40% of the time, wrong 60 or vice versa. What does debit mean? What's credit mean? Right, you got to pay. Okay? There's nothing to it, absolutely nothing to it. Okay, so let's try a couple transactions. Let's do some transactions with this. Okay? Put another sheet up here. It's not like me all of a sudden. Don't do this. Huh. Okay. Try that one. Try that one. Try anything. Sometimes this will work. There we go. Fine. All right. So you have this on your piece of paper where you're trying to do the problems. Really nice idea. Probably the last day of class I'll be doing this. Right? Put it down. Say, hey, you guys, come on. Increase with debits, right? Reduce with credits. Both of these increase with credits, because they're right. Reduce with debits, right, everybody? Revenues have to be credits. Why? Because they increase the equity. Expenses have to be the opposite, so they have to be debits, because we don't add and subtract. We just take the difference between debits and credits. Okay, they got to be debits, because as I increase those expenses, I'm reducing my equity, right? I will. Okay, and then of course you know debits equal credits, which just simply means the left side equals the right side. So we have that, and we have this. Okay, let's go. Let's start a business. Okay, and there are problems. Some of you guys have been working problems already. Somebody emailed me about working on a problem. That's pretty cool already. Well, that's scary, isn't it? What's wrong with those people? Yeah. Okay. Anyway, yeah, I know. That's really awful. You know, you go to work. I got to tell you this. This is great. I was working at Dwyer Thurman in Colson, which is a large local CPA firm in Tacoma, where I was the manager, and that's below the partners manager staff. 24 years old, in about 25. Anyway, we hired these two young guys, and both of them were really a lot of fun to work with. And one was more fun, you know, because he kind of worked hard. Both of them were fun to go have beer with. One was more fun to go have beer with because he stayed longer, you know, when he didn't work very hard. Yeah. Anyway, so, they worked for a year. I got out at the same time. They worked for a year until their raises came. And one got 5 times the raise people. They gave it like a 20% raise. The other one got 4% raise. It's kind of like that. 20% is kind of a nice raise. Might have been 25. Anyway, so they talked to each other, of course, and one guy was really happy, and the other one was kind of sad, and he found out what his friend got, the raise he got, and he was really angry. So we're out having a beer. Keith, what the hell happened? Why did this happen? I said, well, I kind of argued for you not to get fired. And argued for you to have a small raise so you didn't lose all your motivation. That's small in public accounting, 5%. That's small. 4 or 5%. And, you know, he'd say, what do you mean? I came to work every day. I work. And then, yeah, you billed half as much as he did last year. He's a gold mine. You cost me. We paid you more than you generated. He's turned into a gold mine now. Besides, he got 2 years experience last year. You only got 1. Really, maybe he got 3 or 4 and you got 1. If you don't step it up, you're leaving. I don't even need to worry about what he thinks. Just who do you want to be? Which one are you? And that is, by the way, the guy that got the big raise from here with us. Right? He just got to work. Right? He really worked. Right? When you work, you work. I believe that you should play really hard, and you should work really hard. goof off, you should goof off really hard. Do nothing. I have never felt guilty when I've said did nothing. Because when I work, I work. And by the way, if I'm at work, why would I sit and do nothing? You ever seen people play solitaire on their computer? You can wander around and see faculty around this institution playing solitaire on their computer. You know, video games in general on the computer. Solitaire is the primitive ones for college professors who don't work hard. Try to do it, I guess. Right? What do you think they should be doing? Teaching you or playing solitaire? Give me a break. If you got time to do that, go home. Watch a football game, right? Do something productive with your jet, right? If you waste your time, waste it doing something more fun than playing solitaire on the computer. So don't be that person. By the way, is there anything wrong with standing by the water cooler and talking? No, as long as you are talking about business. You're developing relationships. And when you're talking about sports, by the way, by the water cooler, or you're talking about what the new show is, or my wife watched some stupid award show last night. It was something, Golden Globes, yeah. Anyway, she watched that last night. If she were going to work and she was talking to people about that, and that made them have more rapport, so that when they got work, when they were working on work, they could do more. Okay, fine. But what if you spend all your time doing that? Oh, come on, right? Nobody's going to take it to that. So yeah, schmoozing is good, right? Talking to people is good. Getting good relationships is good. What's really good? Producing, right? Producing. So if that helps, do it. That'd be fine. All right. So let's do a couple transactions. Let's say we start the business. Here's our first journal entry. We start the business, huh? And what we do is the owners put $100,000 cash into the business. Give me the journal entry. Give me the journal entry, which just means write down debits, write down credits. We are going. What do we have more of? The owners give the business $100,000 of cash. What does the business have more of? Cash, which is a asset, and therefore all assets are on the left, and therefore they are increased with a debit. Got it. All you do is you debit cash for the $100,000. And notice I wrote it to the left. I don't have to put debit down next to it. I know it's a debit. I don't have to put asset down next to it. I know it's an asset. Put both the name, the account name, right? Account is just a place where you keep track of stuff, right? This is an asset account. The name's over there, cash, right? And we need debits to equal credits, right, everybody? What's the credit? Okay, the company got cash. I have more assets. What do I also have more of in the company? I don't owe them the money. I'm not giving it back. They're my stockholders. What is it? Contributed capital. Absolutely. Which is a what? Equity account. An equity account named contributed capital. Actually, it's going to be common stock later. Contributed capital. Common stock is a type of contributed capital. So I am going to credit contributed capital. Now, why am I crediting contributed capital? Because I have more of it. Credits increase equity accounts, huh? Is there more ownership interest if the owner's invested in the company? Yes, right? So the company has more cash, more asset, and there's more equity. So what just happened? I have a balance sheet now. By the way, what's the balance in all the accounts when you start the company? If you'd never recorded a transaction, it'd all be zero. So what do we just do? We just increased the assets by 100. We now have 100,000 assets, and we increased the equity by 100. We now have 100 of equity. We have no liabilities, revenue, expense. You know why we don't? Because we didn't make a journal entry to record any. So all that's going to happen in a company is, you know, think about this. Amazon, GE, they do billions of transactions a year. Put them in the computer, add them all up, put them on 2 sheets of paper. Balance sheet, income statement. This is power, isn't it? Okay? It's really amazing. And then you guys, hopefully, will be able to take those sheets of paper, each individual sheet for a company, right? Balance sheet, income statement. Know where the company's at is the balance sheet, right? What all their possessions are, all their liabilities are, what their wealth is, right, for a company. And look at all their revenues and their expenses on the income statement for the year. Wow. 1 sheet of paper, billions of transactions. Got the idea here? Why this might be kind of valuable to you? Okay? You ever want to have any money and invest it in something? Any finance types in here? Any finance majors? What are you going to do? Exactly that. You're going to be reading financial statements. By the way, all of you know how to read a financial statement. How many of you can sound out words? How long have you been able to do that? My grandson's unbelievable. My granddaughters at 5 are spelling words that are 4 syllables long. It's scary. Wow. Scary. And they're not brilliant. They're going to be a Catholic principal. So So they're learning all this stuff. They may not know what it is, but they're learning it, right? They can feel it out, right? Yeah. So I bet my grandson could be anything. You, of course, wouldn't know what the words meant, neither would you. He wouldn't know what those numbers meant, or where they came from, or what's behind it, what activity was going on behind it. Neither would you. I would. What do we mean by read financial statements? Know what happened in the business by virtue of looking at two pieces of paper. Where they're at, what they're doing, have a million questions you could ask based on that, right? And ultimately decide whether or not you want anything to do with them. Work for them, invest in them, loan them money, right? Be their customer, be their vendor. Do you want to sell something to somebody who's not going to pay you? Boy, you analyze who you want to sell things to. You're their vendor, right? Okay, what's the other way around? They're your customer. Yeah, you're their vendor, they're your customer, etc. Okay. By the way, do I want to buy things from somebody who's going to go broke? Do they want them to be my vendor? They're selling to me, I'm selling to my customers, and all of a sudden they tell me, oh, sorry, we can't sell you anything anymore because we went broke. Oh, what? I want to know what's going on, right? Who I'm doing business with. Do you want to go to work for somebody who's going to go broke? Not particularly. Although it can be kind of fun. I used to work on bankruptcies a lot. It's kind of fun to get involved in a bankruptcy and try to save them, and then when they don't make it, oh, well, you move on to the next one. I didn't go broke, they did. I developed a skill. Right? I tried to keep them from going broke, but you know, sometimes it works, sometimes it doesn't. Okay, don't start leaving yet, unless you have a class after this one, then you can go. Let's do another transaction. Let's borrow $50,000 at the bank. If you have another class, go. If you don't, don't. Right? Let's borrow $50,000 at the bank. What do we get? An asset name. Debited, right? Yeah. And what would you credit? A liability. What do you think you'd name that liability? I bet we'd sign a piece of paper called a note, stipulating when we're going to pay and what the interest rate is. Note what? Payable. Absolutely, guys. That's it. How much cash do I have now? 150. See how easily that is to add it up? So I have 150 of assets. I have contributed capital, 100 of equity, and I have a liability of 50. Is 50 plus 100 equal to 150? Yeah, works good, doesn't it? Let's do one more thing and we'll get out of here. Okay, here's the deal. Let's say that I buy a truck. I'm buying the truck for $20,000. Cash. What would you debit? What'd you get? I got a truck. Delivery equipment, truck, equipment, whatever we want to call it. Right? Which is it's a debit because I have more of a asset. Yeah, it's an asset, right? So that's the process. What did I get? What is it? And do I debit or credit? So it's a truck, huh? So debit trucks, 20,000. I have more of that asset. What do I have less of? Cash, which is a asset. And I have less. What do you want to do to an asset to reduce it? Credit it. Absolutely. Cash goes down. It's that simple, you guys. So now what do I have?
130.
These T accounts represent general ledger accounts where I keep track of things. There's not really a T in the computer. Positive, negative charges in the computer, right? But anyway, yeah, but keeps track of the debits and credits and balance for us in the computer. So I've got cash. I have trucks. Those are my assets. I have notes payable, right? What I owe. And I have contributed capital, don't I? Let's post these. This is copying, posting into the general ledger. General ledger is where we keep track of all the accounts. A ledger used to be a book, right? You know, physical manual book. Cash goes up by 100. See it? That first one? Contributed capital goes up by 100. Are we in balance? Debits and credits? Sure. Cash goes up by 50. We now have 150. That's this one. Notes payable goes up by 50. Am I still in balance? Sure. Assets equal liabilities plus equity, don't they? Then what? Trucks go up by 20. Whoops. Trucks go up by 20, and cash goes down by 20. How much cash? Somebody said it. How much was it? It's 130, isn't it? What do I have in assets? 130 cash plus 20 trucks is 150, don't I? This is 150 now, isn't it? Debits. What do I have in liabilities? 50. What do I have in equity? 100. Of course, it stays in balance. Okay? Work through a bunch of problems and do that quiz for next time. And we will work the quiz in the review session in class. We'll work a bunch of problems. That's what we're going to do. Okay? And you guys will be ready on Friday. Give me lots of hours between now and Friday, and it'll really pay off for you on the first test and the final. Right? It really will. You can either make this slide be a piece of cake, or make this class be hell. Up to you guys, not me.
Like, 20 to fill out the form.